Hey, I'm back with your weekly market insights brought to you by the Capital Markets Trading Desk. Every week, I break down what's happening in the economy, mortgage rates, and housing, making the market easy to understand no matter your experience. So let's jump in. It was another roller coaster week for the markets as investors weighed changing geopolitical headlines, strong corporate earnings, and a fresh round of economic data. Stocks moved closer to record highs thanks to solid earnings, while treasury yields and oil prices bounced around as inflation expectations shifted throughout the week. Add in mixed labor market data and a weaker US dollar, and investors are all asking the same question. What's the Federal Reserve going to do next? Let's break down the numbers. So, first, some encouraging news from the labor market. US labor cost growth stayed steady during the second quarter, suggesting wage pressures are contributing very little to overall inflation. The Employment Cost Index, which tracks wages and benefits, rose 3.4% year over year in the 12 months ending in June. Next up, trade. The U.S. trade deficit narrowed in June as imports declined for the first time this year. The goods and services trade gap shrank 5.6% from the previous month to $73 billion. Imports fell 1.8% while exports slipped 0.9%, pointing to a slowdown in global trade activity. Now here's another bright spot. Productivity came in stronger than expected. U.S. labor productivity increased 1.4% in the second quarter, while unit labor costs rose just 1.3%. That's a sign businesses are becoming more efficient while keeping labor cost growth relatively contained. Now let's talk jobs. The labor market continues to show resilience despite a few mixed signals. Initial jobless claims increased by 1,000 to 199,000 for the week ending August 1st, still hovering near historically low levels and reinforcing a tight labor market. Meanwhile, continuing jobless claims climbed by 24,000 to 1.8 million for the week ending July 25th. So while layoffs remain limited, it's taking some workers a little longer to find their next opportunity. Now, what's happening in housing? The housing market remains under pressure as mortgage rates climb to their highest level in a year. The average contract rate for a 30-year fixed mortgage increased 5 basis points to 6.8% for the week ending July 31st. Higher borrowing costs continue to weigh on borrowers. That showed up in mortgage demand as well. The MBA Mortgage Applications Index fell 2.9% during the week. Purchase applications dropped 3.6%, while refinance applications eased 1.9%, highlighting that affordability remains one of the biggest challenges facing today's housing market. So, what's the big picture? This week's data tells the story of an economy that's still resilient, but gradually cooling. Wage growth remains contained, productivity continues to improve, the labor market is holding firm. At the same time, softer trade activity and a slower housing market show that higher interest rates are still having an impact. Looking ahead, investors will be paying close attention to upcoming inflation reports, additional labor market data, and any comments from the Federal Reserve for clues about where interest rates go next. With markets still sitting near record highs, every economic report could have a major impact on investor sentiment in the weeks ahead. And that's your weekly market insights. If you found this helpful, be sure to like this video, follow for more weekly market updates, and share this with someone who wants to stay ahead of what's happening in the economy, mortgage rates, and housing. Until next week, stay informed, stay ahead of the market, and remember, nothing is beyond reach. Buffy out.